Fundamental business metrics that investors often consider when determining if a company is secure enough for stock purchase. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a measure used to evaluate a company's operating performance. Here are some key points about EBITDA. It is an alternate measure of profitability to net income. By including depreciation and amortization as well as taxes and debt payment costs, EBITDA attempts to represent the cash profit generated by the company's operations. EBITDA is not a metric recognized under generally accepted accounting principles. Some public companies report EBITDA in their quarterly results along with adjusted EBITDA figures, typically excluding additional costs, such as stock-based compensation. The U.S. Securities and Exchange Commission requires listed companies reporting EBITDA figures to show how they were derived from net income, and it bars them from reporting EBITDA on a per-share basis. Earnings before interest, taxes, depreciation, and amortization equals net income plus taxes plus interest expense plus depreciation. Earnings before interest, taxes, depreciation, and amortization is a widely valued metric. Remember, EBITDA, price-to-earnings ratio, P/E ratio. This ratio helps investors determine the market value of a stock compared to the company's earnings. A high P/E ratio could mean that a stock's price is high relative to earnings and possibly overvalued, while a low P/E ratio might indicate that the current stock price is cheap relative to earnings. Average P/E ratio. The average P/E ratio is typically around 20 to 25. Anything below this range could be considered good, while anything above might be seen as overvalued. It's important to note that these are general guidelines, and the goodness of a P/E ratio can depend on the specific circumstances. For example, a high P/E ratio might be justified for a company with strong growth prospects. Also, P/E ratios are most useful when comparing companies in the same industry. Comparing P/E ratios across different industries might not provide meaningful insights due to differences in growth rates, risk levels, and profit margins. Remember, while the P/E ratio is a useful tool, it should not be the only factor considered when evaluating a potential investment. Other financial metrics and aspects of the company should also be considered. It's always a good idea to do thorough research or consult with a financial advisor before making investment decisions. Price-to-earnings ratio, P/E ratio, is also a widely used metric. Price-to-book ratio, P/B ratio. This ratio measures whether a stock is over or undervalued by comparing the net value, assets, liabilities of a company to its market capitalization. Debt-to-equity ratio. This ratio is used to evaluate a company's financial leverage and is calculated by dividing a company's total liabilities by its shareholder equity. Please like and subscribe to this channel. It is good luck. Earnings per share, EPS. EPS is a measure of a company's profit. It's calculated by taking the profit, subtracting preferred dividends, and dividing that number by the number of shares outstanding. Return on equity, ROE. ROE measures a corporation's profitability by revealing how efficient a company is at generating profits. Return on investment, ROI. ROI is simply the money a company has made or lost on an investment. Free cash flow. This is a stock metric showing how much cash a company has after deducting operating expenses and capital expenditures. Year-on-year, YoY growth. This metric shows the percentage change from the past year. This can be applied to any metric, but it's often used with revenue, earnings, and cash flow. Profit margin. This is a profitability ratio calculated as net income divided by revenue, or net profits divided by sales. Profit after tax, PAT. This is the net profit a company has made after deducting all business expenses, interest charges, and taxes. Remember, these are just some of the metrics used in fundamental analysis of a company's worthiness for investment. It's important to consider a variety of factors and metrics, as well as your own investment goals and risk tolerance, before making investment decisions. Please like and subscribe to this channel.